Alright guys, welcome back to my YouTube channel, Study with Clef. My name remains Caleb and today we'll be talking about IAS 16 like I mentioned in the last video. So we've laid foundation of assets generally. So IAS 16, which talks about property, plant and equipment, relates basically on assets, especially non-current assets. So at least we now understand what assets are, what non-current assets are, and the likes of such. So property, plants, and equipment, as defined by 16, we have the definition, recognition, measurement, and derecognition. These are key things that must be known. So definition of PPE of assets in accordance with IAS 16 said assets are resource controlled, just like I've mentioned, as a result of past events in which future economic benefits are expected to flow into the entity. So IS 16 states that assets which should be classified under property, plant, and equipment, they are assets held for use and administrative purposes. Purposes in the ordinary course of the business. So as it relates, this particular definition is very important because you have to know which assets should be classified as a PPE item, which is property, plant, and equipment. Like we say, assets held for use and for administrative purposes are those assets classified under IS 16. So every other asset like assets held for sale is not governed under IS 16. I'll do a recap of those items not covered by IS 16. So IS 16 covers assets which are held for use and for administrative purposes in the ordinary course of the business. So those are part of what is recorded as IS 16. So what the recognition criteria. So like we mentioned, we define assets and I've defined it again. So for you to recognize an asset, it must meet two things. So the recognition criteria. According to IS 16, before you can recognize an item of PPE, it must meet these two criteria. One of them is that the item must be able to generate future economic benefits. So it must be able to generate future economic benefits. Like I said, that PPE items are non-current asset item. So it must be able to generate future economic benefits before you can consider it as an item of PPE. That's one. And secondly, um, must generate future economic benefits. And then it must be reliably measured. So before it is considered as an item of PPE, that item or the asset must be able to generate future economic benefits. And secondly, it must be reliably measured. If it is not reliably measured, then it should not be part of IS 16. If it cannot generate future economic benefits, then it should not be recorded or regarded as IAS 16. So that's for the recognition criteria. Now to the measurement. So I may be a little bit fast because of the example which we are going to take. Measurement. So recognition means that before you include them in your financial statement, like we already said, or like we have defined and we have stated, we've explained before that IX 16 deals with non-current assets. So basically it's on assets, and assets are under statements of financial position. So before you can classify this thing as a non-current asset item, so meaning that IAS 16 non-current assets. You must always know that IAS 16 relates to non-current asset items. So before you can consider them as a non-current asset item in the statement of financial position, then future economic benefits must be probable. It must be probable that future economic benefits can be generated from the use of that asset. Don't forget that items classified as 16 are assets held for use, not assets held for sale, not assets held for capital appreciation. Those ones are governed by another standards entirely. They are also still under non-current assets, but not in the scope of IAS 16. So, and it must be reliably measured before you can say it's an item of IAS 16, which should be recorded as a non-current asset item in the statement of financial position. So, moving to the measurement, we have the initial measurement, and the subsequent measurement. So initial measurement means that how do we recognize assets at the first time, like the first time of the occurrence of this item? How should we include it in our books? How should we include it in our statement of financial position as a non-current asset item? So that's initially when we actually bought this thing. For example, let's say motor vehicle, which we said is an example of non-current assets under the scope of IAS 16. That's meaning that it is used for administrative purposes in the ordinary course of the business. Don't forget that term must be related to it before you can classify it as an IAS 16 item. So using motor vehicle as an example, if we buy motor vehicle for, let's say, 30,000, how should we recognize that 30,000 in our book? Should we just say that 30,000 is the value for this item or for this asset, which is motor vehicle, which is initial recognition? So as at that time, or as at the date when this asset was purchased, how should we recognize it? How should we include it in our financial statement? That's initial recognition. Then subsequent recognition is in the later days. Remember that this is a non-current asset item. I explained in the previous class that non-current asset item are those assets that can be held for use for over an accounting period. That's over 12 months. So that's for non-current asset item. So how do we use this? How do we recognize it in our books in future? That's after we've purchased it initially, like in the next 1 year, in the next 2 years, depending on the lifespan of this asset. So how do we include it in our books? That's subsequent recognition. So for initial recognition, IAS 16 states that assets should be measured at cost. Initial measurement rather. So assets should be measured at costs. While for costs in the sense that the actual amount you purchased this asset for, We'll still define costs because cost has some elements under it. So the actual amount we purchase this thing and every other uh, amount related to that purchase of that asset. So for example, if I buy something for 30,000, that same motor vehicle, which we are using as an example, if I buy a motor vehicle for 30,000 and I had to transport myself from one place to another, I should be able to add that transport cost as part of my cost of purchasing that asset, which we will deal with later. Then for subsequent recognition, we have is either you measure at cost, then or you measure at evaluation. So this is cost model, or evaluation model. So under initial recognition, initial measurement, you have just cost model as your record. That's the actual way you actually recognize your assets when it was initially purchased. You use cost model. Then for subsequent measurements, that's subsequently, how do you also recognize this particular asset in the books of your account, that's in your statement of financial position? You can either recognize it using cost model or you use revaluation model, which will also split. So coming to initial measurements now, we have some components under cost model. So cost model doesn't completely relate to the actual cash paid for the assets. Some other costs are related as part of cost. So in subsequent times, we'll be talking about capitalization and also expensing, which we'll dwell on subsequently. That's later in the day or in our future classes. So cost model, you have some components of cost model. One of them is the purchase price. Then you have additional costs. Which can be attributed to the purchase of these assets. Then the third one is dismantling costs. So purchase price on its own, purchase price is just the actual cash that you pay to collect or to in exchange for the assets purchased. So if I pay 30,000 to acquire an asset, then I can say my purchase price. That's the actual amount which I've paid to this person. So purchase price is purchase price less any trade discount. So in case you have an asset worth 80,000 and you are given a discount of 6%. So let's just do an example of that. So for purchase price, if for example you have a 30,000 worth of motor vehicle, this is 30,000 naira, just an example. This is motor vehicle, and then you are given a 6% discount, trade discount, not cash discount, trade discount. So according to IAS 16, your trade discount must be deducted from the actual amount of the motor vehicle. So meaning that initially you are supposed to pay 30,000 for the purchase of this motor vehicle, but you were given 6% as trade discount, meaning that you did not actually pay 30,000 in exchange for that motor vehicle. So you paid 6%, 6% of 30,000 will be 6% of 30,000. You have 1,800. So you are given trade discount of 1,800. According to IAS 16, this 1,800 must be deducted from the actual value of this motor vehicle. So, meaning that your purchase price will be initially 30,000, then trade discount, which is 1,800. What you should record should now be 28,200. So you should not record 30,000 as the cost of this motor vehicle because you have a trade discount of 1,800. So you have to deduct your trade discount from the cost of the motor vehicle according to IAS 16. So that's one thing you should also take note. So that's part of the purchase price. Then the other one is, all right, so the next one is the additional costs. So additional costs that you can also capitalize. Capitalization, like I have said, is meaning that you are adding it as part of the cost of an item. You're not taking it as an expense. We said assets are classified as uh, an item of statement of financial position. So if I say that I'm capitalizing something, it means I'm including it as part of item which should be carried forward. That's over an accounting period. That's year in, year out. Account balances. We've differentiated between statement of profit or loss and statement of financial position in a previous class. So here, additional costs. These are costs that should be capitalized as part of the cost of this asset. So we have example of them to be professional fee, professional fees. We have site preparation fees. Then we also have the borrowing costs. Borrowing cost has a standard on its own, which is governed by IAS 23, which we'll also look into in our subsequent classes. So additional costs relates to other costs that should be added as part of the cost of this asset. So professional fees, these are, for example, motor vehicle, if I need a mechanic, just for example, to check the worth of that motor vehicle, just to check the condition of the motor vehicle, if it's working well or not. So the amount I paid to that professional fee or to that mechanic should be added as part of the cost of this asset. So for example, I purchased the motor vehicle for 30,000 and I paid a professional person, which is like a mechanic, let's say 5,000, just to help me check the value of that condition of that motor vehicle, to check the condition if it's in good condition. Then the 5,000 I paid to the mechanic should be added as part of the cost of this asset, meaning that I will have 30,000 plus 5,000. So 5,000 will be added as part of the cost of it. Another one under additional cost is the site preparation cost. So site preparation, for example, I purchase a generator. I have to drill the land, I have to clear the space, do some concrete, uh, arrange the place which I'm to place this generator. So all those costs which I've spent, all the amounts I've spent in preparing this site are recorded as site preparation cost, which should also be added as part of the cost of this asset. Don't worry, when we look at the example is detailed enough to show all of these things. So Then borrowing cost, on the other hand, which I say has a standard on its own, that's IAS 23. Borrowing costs are additional costs of financing, the interest which must be paid on financing. So, for example, I'm to buy motor vehicle of 30,000, and before I can buy that motor vehicle of 30,000, I have to borrow loan of 20,000. Let's say with 1,000 interest. That 1,000 interest should be added as part of the cost of this asset, although it is beyond that because it has a standard on its own, which we'll also look into. So these are examples of additional costs which should be added as part of the cost of this asset. So that's that. So the third one under the cost model is the dismantling cost. So dismantling costs, this specifically relates to buildings. So for example, I want to construct a new building in a place which already has a building on it. If I'm going to dismantle the previous building before I can build a new one, the cost of dismantling the previous building before I can now build another one on top of it should be added as part of the cost of building a new, let's say, warehouse. The new warehouse. If I'm going to build a new warehouse where there is already a factory, so meaning that I will have to dismantle the factory before I can build my warehouse. So the cost of dismantling that warehouse or that factory should be added as part of the cost of my warehouse. Is that clear? So that's dismantling costs on its own. So these are part of the cost model, meaning that those things which should be added as part of the cost initially. All of these are still at the initial stage when I actually purchase this asset or when I actually want to start this thing. So we'll still look at examples of IAS 16, which I've already given before, but we'll still do them for referencing. So that's dismantling cost basically. So for subsequent measurement, we have either cost model or revaluation model. Now, after an accounting period, it means subsequent measurement means after an accounting period has passed. So how should we recognize this asset subsequently? So we have either cost model. The cost model here for subsequent measurement, we said it's either cost model or evaluation model. So this cost model is cost, like we have defined cost. We have also shown all the particles or parties related to cost. So cost minus accumulated depreciation minus accumulated impairment losses. So this is accumulated depreciation and accumulated impairment losses. So cost model now subsequently, it is not at the initial stage any longer. So you have cost model, it is expected for assets to depreciate, especially non-current assets to depreciate in an accounting period. That over a 12 month, it is expected for an asset to depreciate. So cost less accumulated depreciation, less accumulated impairment loss. Impairment loss is the reduction in the value of an asset. This has a standard on its own, which we'll also look into. Like I said, they are all related to each other. So we'll take them together so that it can help with the flow. This is governed by AS 36, which we'll look into also. So that's for cost model. Now under subsequent measurement. Now for revaluation model, which is the second one, it is the fair value also has its own standard, which is IFRS 13, and we'll explain this very well when we get to uh, the standard. So fair value is just like the actual amount which uh, we can receive for this asset, like the actual worth of this asset in the market. So according to IFRS 13, fair value is defined as the amount that will be received uh, to sell an asset, or amount that will be paid to transfer a liability in an orderly transaction between market participants at a particular time, or at a measurement time or measurement date. So that's fair value. That's the actual worth of this asset in the market, current worth of the asset in the market. That's fair value. So revaluation model states that for you to be using revaluation model for an asset, it requires you to always revalue your assets yearly. So you should always test for revaluation every year. Is either you use cost model, which aligns with this, or you use revaluation model, which is your fair value. It will also have less accumulated depreciation. Like I said, assets are expected to depreciate over an accounting period, then less accumulated impairment losses. So that's fair value or revaluation model, cost model, and revaluation model. So these are basically the measurements of IAS 16. So before we move to the example, we also have the recognition. So the recognition only states that the recognition of assets, that an entity should derecognize an asset when these two recognition criteria can no longer be met. Remember that we said we have two recognition criteria, which is if it is probable that future economic benefits will flow to the entity through the use of this asset. Then secondly, if it can be reliably measured. So as long as the asset can be reliably measured and will generate future economic benefits, then it should still be recognized in the books of the account. But if it can no longer generate future economic benefits, then you should derecognize that asset. You should derecognize it from your books of account. Derecognizing it from your book of account means that you are removing it from your statement of, this is from your statement of financial position. So if it can no longer generate future economic benefits, it is expected that you should not recognize that asset or that item as an asset in your statement of financial position. And also, if it cannot be reliably measured, for example, I'm expecting a motor vehicle which I don't know the value, I don't know actual amount which I will pay for this thing. So I cannot actually say that it's an asset because I cannot measure it reliably. So that's recognition criteria. So lastly, before the example, we also have uh, some examples of assets under IAS 16. Remember, according to the definition, we said you can only recognize assets under IAS 16 if it is held for use or for administrative purposes in the ordinary course of the business of an entity. So examples of these assets now can be motor vehicle, which I'll be using as an example, motor vehicle, then land and building. Let me let me separate the land and building because of a reason. Land, building. In some cases, they will join them together, and in some cases, it will be separated. But furniture and fitting, have computer equipment, and that's these are some examples of assets classified under IAS 16. So as long as we are using this motor vehicle for company's use, then it is classified as an asset under IAS 16. If the land is for administrative purpose and not for capital appreciation, if it is for capital appreciation, it is not governed under IAS 16, but rather under IAS 40, which is investment property. Then building, if we are using the building for company's use, administrative purposes, then it is also under IAS 16. Furniture and fittings, just like the cabins and every other furniture, if they are used for company's use, then they are classified under assets under IAS 16. Then computer equipment, just like we know, if they are used for company's use, then they are classified under IAS 16. So we have some examples of assets not under IAS 16, which you should watch out for. These are, one of them is assets held for sale. Assets held for capital appreciation. We also have leased assets. So assets held for sale in the ordinary course of, sorry, in the ordinary course of a company's business are governed by IAS 2, which is inventory. So we produce this thing so that we can sell them. An example is motor vehicle. If I'm into selling of cars, I cannot take motor vehicle as an IAS 16 item, but rather it will be an inventory to me because of the nature of my business. If I'm into the selling of cars, then motor vehicle becomes inventory to such companies. So it depends on the purpose of that item or of that asset. That is what will determine where you classify each of these assets. So assets also held for capital appreciation is governed by IAS 40, which is investment properties. Then leased assets, that's right of use assets. So in some cases, you'll see this as right of use assets. This is also governed by IFRS 16, which I think I mentioned previously. So these are also, these are just example of assets not under the scope of IAS 16. So you should watch out for the purpose of the use of that asset before you can classify them either as an IAS 16 item or other type of assets. They are still all under non-current assets depending on the scope. So the last but not the least is bearers plants, which is also classified under IAS 16. Bearers plants are living plants which you generate agricultural produce for sale. So as long as you are still generating uh, fruits from a plant, then it is still governed by IAS 16. So when you harvest those fruits, it becomes inventory to be sold. So, but that is completely under IAS 40. So under IAS 40, you differentiate each of them. So that's for now. We'll take an example All right, so to the example, ICAN November 2020 Skills Diet, question 6. So, question on Noodle Nigeria Limited. So, I'll just read the question briefly. So, Noodles Nigeria Limited manufactures various types of noodles in Oluyole for sale across the state in Nigeria. Recently, to continue to sustain leadership of the company in the Nigerian market, on September 1st, 2015, a brand new machine was bought from a supplier under the following condition. You have sell supplier's invoice price and all of those details, trade discounts, discounts applicable, freight and shipment costs, stevedore expenses, initial operating losses, handling costs, electrical and installation costs, interest on loan to the point of usage, interest on loan after the usage, pre-operational expenses, staff training in use of the machine, professional and consultancy fee, that's purchase of 4-year maintenance contract, pre-production testing cost, then estimated residual value. Estimated useful life in machine output is 5 million. That's 5 million units. Now, actual, we have given years 31st August 2016, 31st August 2017, 31st August 2018, and 31st August 2019. The output 1,000, 1,200, 1,400, and 800,000 respectively. So on September 1st, 2016, Noodles Nigeria Limited decided to upgrade the machine by adding new major components at a cost of 300 million. As a result of the new upgrade, there was an increase in the remaining useful life of the output to 8 million units on September 1st, 2016, and the residual value of the machine was revised to 114 million. So you are required to describe what is meant by depreciable amount. Okay, we've not talked about depreciable amount, which we will actually do. Within the context of IAS 16 on property, plant, and equipment. Then B, highlights 3 characteristics of depreciable assets under IAS 16. So describe 2 models of accounting for costs of property, plant, and equipment under IAS 16, which we've talked about. Now calculate the following: machine cost, the revenue expenditure over the years of the statement of profit or loss, then carrying amount of the machine over the years. So about the first one, which is depreciable amount. So depreciable amount is just the net amount this is the net amount spread over the useful life of an asset after the deduction of the scrap value. Scrap value, which is the same thing as residual value. So in short, we have depreciable amount equals your cost less residual value. So that's your depreciable amount. So the next one is highlight 3 characteristics of depreciable amount of depreciable assets. Just like we've said, at first it must be used for production or for administrative purposes. It must be reliably measured, and it must be probable that future economic benefits must be able to flow into the entity through the use of this asset. Then the third one says describe the 2 models of accounting for cost of property, plant, and equipment, which we've talked about. We have the cost model and the revaluation model. So we've explained both cost model and revaluation model earlier. Then calculate the following. The first one now is to calculate the machine cost. So just like I've explained previously that cost is not only limited to the amount paid on an asset, but it also includes other costs. So calculation of the cost of machine. So according to the information given, we said we were given suppliers invoice price, which is the actual amount paid for these assets, all figures suspended in thousands. We have suppliers invoice price, which should be part of the cost of this asset. Here we have it as 500,000. Then we have, like I said, we have trade discounts. You have to deduct trade discount, which I mentioned. We were given trade discount of 25% on the invoice price. So trade discount, which is 25% of 500,000. I think that should give us 25% is 0.25 times 500,000. So 125,000. So for those that are new to accounting, when you see things in brackets like this, it means you are deducting. Then we have discount applicable on invoice price for early settlement. This is cash discount. Cash discount. So cash discount is an income. It doesn't even come as an expense or as an additional cost to the purchase of this machine. So cash discount does not relate to this at all. Then the next one is freight and shipment cost. When I mention additional cost attributable to the cost of the asset, shipment costs are also part of it, just like installation costs. So we have freight and shipment cost. So freight and shipment cost is 100,000, which should be capitalized. I explained what capitalization means. It means you are including it as part of the cost of the asset. Then the next one is stevedore expenses. Stevedore expenses are expenses incurred for carriage, basically, especially on dockyards or something like that. Stevedore expenses, which is 20,000, which should be capitalized. Then the next is we have initial operating losses. Initial operating losses are not coming here. Those are operating expenses which should be expensed. So when we get to expense item, I think the second part of the question is talking about expenses. So we'll note that to be part of expenses. Then the next is handling cost. Handling costs are part of additional costs which should be capitalized. Handling costs. So handling cost is 15,000. Then the next is electrical and installation cost, which I mentioned. These are parts of additional costs. Electrical and installation cost. So electrical and installation cost is 25,000. Then the next is interest on loan to the point of usage. Interest on loan to the point of usage. So to the point of usage, you are not to capitalize that interest. It should be expensed. Then the next one is interest on loan after the usage, not during the usage. So after the usage also, it is to be expensed. Then the next one is pre-operational expenses. these are expenses, pre-operational expense, meaning that those expenses incurred before we actually start the usage of this asset. The next is interest on loan to the point of usage. Interest on loan to the point of usage will be expensed to not be capitalized as part of the cost of the asset, followed by interest on loan after the usage, which will also be expensed in the statement of profit or loss. Then we have pre-operational expenses. Pre-operational expenses will also be expensed in the statement of profit or loss. We also have staff training in use of the asset, in the use of the machine, which is 4 million, should also be expensed in the use of the asset, should be expensed to the statement of profit or loss. Then professional and consultancy fee. Professional and consultancy fee. So professional and consultancy fee is 30,000, followed by the purchase of a 4-year maintenance contract. 4-year maintenance contract, which is synonymous to repairs and maintenance, will also be taken as an expenses. There is only a condition that will make us take repairs and maintenance as part of the cost of the asset. That's if it will increase the useful life of the asset, or if the amount is of a large amount in nature. So, but in this case, we have purchase of a 4-year maintenance contract, which will be expensed in the statement of profit or loss, spread over the useful life of this asset. So the next one here is pre-production testing cost. So pre-production testing cost is 13,000. And lastly, we have pre-production testing cost as a condition also. If your pre-production testing clause will generate a gain, the part that generates gain should be removed from the total testing cost. Meaning that if, for example, the total is 13,000, but out of the 13,000, we're able to generate like 4,000 successfully, it should be deducted from the total testing cost of 13,000. Meaning that only 9,000 should be taken as the capitalized cost to the cost of the asset. So the next one is estimated residual value, which is just scrap value, which we use in calculating our depreciable amount. So that is not an expense, neither is it part of the cost of the asset. So we have this to be the total cost of the asset. So we're adding all of this, which is 500 minus 125 plus 100 plus 20 plus 15 plus 25 plus 30 plus 13. So we have 578. So our cost of the machine is no longer 500 million, but 578 million as computed. So due to additional costs and the removal of the trade discount from the cost of this asset. So the following, or the next thing on the question, is to calculate the revenue expenditure over the years in the statement of profit or loss. All right, for the next part, says calculate the revenue expenditure over the years in the statement of profit or loss. So we're given 4 years as the useful life of this asset. So although the useful life was not given particularly years, it was given a number of units that can be produced in the next 4 years as the useful life of this asset. So we're given 31st May, 31st August 2016. So since the company, or since the accounting period is starting on the 1st of September 2015, then the accounting year end will be 31st August 2016. That will be for the first year. 31st August 2017 for the second year. 31st August 2018 for the third year, and 31st August 2019 for the fourth year. which is the useful life of this asset. That's 4 years useful life. So naira in thousands. So to show the expenses, revenue expenditure, this is an extract for the statement of profit or loss and other comprehensive income. Like I've explained previously in the previous class, what statement of profit or loss entails and those items under them. So this is just like an extract of what belongs to statement of profit or loss. So part of the expenses is the initial operating losses. Initial operating losses, which was not stated to be spread over the useful life of this asset. Only in the first year, that's as at the year end 31st August 2016, which is 10,000. 10,000. The next is interest on loan to the point of usage. Like I have said, interest on loan to the point of usage. So interest on loan to the point of usage is 12,000. We also have interest on loan after the usage, just as it was stated in the question. We have 18,000, then followed by pre-operational expenses. I mentioned that these things are to be expensed and not capitalized. Pre-operational expenses, which is 5 million, already suspended in thousand. Then we have staff training. Staff training costs are expensed, they are not capitalized. Staff training costs, which is 4 million, suspended in thousands. Professional and consultancy fee is to be capitalized, which we have added as part of the cost of this asset. Pre-production testing costs is also part of it. So we have purchase of a 4-year maintenance contract. So this is a 4-year maintenance contract. It means that the amount should be spread over the years of this contract. It's a 4-year maintenance contract, which is 120 million. So 120 million will be spread over 4 years. Purchase of a 4-year maintenance contract. So 120 million divided by 4 years. So we'll have 30 million each. So we'll have 30 million for year 1, already suspended, 30 million, 30 million in year 3, and 30 million in year 4. This gives us a total of 120 million for the purchase of maintenance contract. So the only thing left to be added as part of these expenses, which is part of statement of profit or loss, is the depreciation for each year. That's depreciation charge for each year. So depreciation is calculated using the depreciable amount. So depreciation is depreciable amount divided by the estimated useful life of the asset. But in this question, we're not given just only the estimated useful life, but given the total number of units that can be produced. So depreciation can be calculated using several ways, which some of them include the straight line method, which we already know, I believe, but we'll show them basically when we're doing published accounts. We'll work more on depreciation, straight line method, reducing balancing method. Just follow me through so that we'll do this together. So depreciation in this case is to be calculated using the number of outputs which has been given. In the question, it was stated that estimated useful life in machine output was 5 million. So over the years of this asset, it can only produce 5 million. And we're given each amount it can produce in every year. So in year one, it can produce 1 million out of 5 million. So we should depreciate this asset with their number of units for each year out of the total amount of units that can be produced. So we'll share the total depreciation of this asset using their units produced in each year. So depreciation now. The next question after, we're not done with this though, but the next question after it states that we should calculate the carrying amount of the machine over the years. So over year 1, year 2, year 3, and year 4. So the carrying amount basically is carrying amount, which I will be shortening now. Carrying amount is CA, so I'll just be writing CA instead of carrying amount. Is cost less accumulated depreciation. Accumulated depreciation means the depreciation for all of the years since the asset has been purchased or since you have produced that particular item. Reason why I used produced was because of some specific item. So less accumulated depreciation, less accumulated impairment losses. I mentioned earlier that impairment is the reduction in the value of an asset which already has a standards on its own. We'll look purely into impairment in our subsequent class. Impairment is governed by a standard on its own, which is IAS 36. And we'll focus on that in our next class. So, cost less accumulated depreciation, less accumulated impairment losses. And we say that before we can calculate depreciation, we need depreciable amount. So it is depreciable amount that we use in place for calculating depreciation. It means the net amount that can be spread over the useful life of the asset, which is the depreciable amount. So it is the amount that can actually be depreciated. So in this case, for year one, depreciable amount is, we've already stated earlier that depreciable amount is cost minus residual value. So our cost in this question, we've calculated our cost now. It is no longer 500 million, but 578 million. So 578 million minus, we were told that the residual value is 90 million. So minus 90 million. This will give us the depreciable amount. Not the depreciation, but the depreciable amount. So depreciable amount is 578 million minus 90 million. So I don't know, this may be mistaken for depreciation. This is depreciable amount. Depreciable amount. Depreciable amount. Amount. So which is 488 million. So 488 million is what will spread over the useful life of this asset to get our depreciation for each year. So in year one, our depreciation will be, so this is the depreciation now. They said depreciation is depreciable amount divided by the number of units or estimated useful life. So here, we are given depreciable amount, or we calculated our depreciable amount to be 488 million multiplied by 1. We said it can produce 1 million units in year one. So 1 million units out of the total 5 million units that can be produced in year one. That's divided by 5 million units. I've suspended the zeros just to save time. So here we have 488 million times 1 divided by 5. So depreciation for that year, or for year one, is 97 97.6 million. So depreciation for year one is 97.6 million. That's 97,600,000. Therefore, carrying amount as at year one. So year one, carrying amount according to the requirement, we have to calculate carrying amount at the end of each year. So we said carrying amount is cost less accumulated depreciation less accumulated impairment losses. But in this question, we actually do not have impairment losses, but this is the actual way of getting your carrying amount. But we don't have impairment loss in this question. So carrying amount is your cost less accumulated depreciation. Your cost is 578 million. You are not using your depreciable amount. You are using your actual cost. It means that after the useful life of the asset, your value should still reflect 790 million as the value that will be left in the books of accounts, which you will realize after the sale of the asset as scrap, just like the name, scrap value. So we will sell this asset after its estimated useful life for 90 million. That's after we can no longer use this asset, we can still sell it for 90 million. So that's the meaning of residual value or scrap value. So that's as at year one. That was what was determined. So here, carrying amount is cost, which is 578 million, minus depreciation, which is 97.6 million. So carrying amount for year one becomes 480,400,000. That's 480.4 million. So this is the carrying amount for year one. So for year two, so we were given an information. We said on 1st September 2016, Noodles Nigeria Limited decided to upgrade the machine by adding new major components at a cost of 300 million. So Noodles decided to add 300 million. That's improving this asset. And we said we can only capitalize such amount if it will increase the useful life of the asset. So we were now told that as a result of the new upgrade, there was an increase in the remaining useful life of the output to 8 million. So we have used 1 million out of 5 million that can be produced. We are left with 4 million. So instead of 4 million, 4 million output that should be produced as at the beginning of year two, we were told that it is no longer 4 million, it is now 8 million. So meaning that each year have been doubled. So each year production have been doubled. So it was supposed to remain 4 million, which is the total output that will be produced at the beginning of year two. So going forward, so instead of 4 million, it has increased to 8 million. So each year has increased their output by itself. That's the double of what they can actually produce. So estimated useful life has increased to 8 million instead of 4 million. So year two, we said our additional cost is 300 million, which will be added as part of this cost, additional cost, since estimated useful life can be increased or was actually increased. So the value as at the beginning of year one is the carrying amount at the beginning of year one. Sorry, the value at the beginning of year two is the carrying amount at the end of year one. So carrying amount or cost at the beginning of year two is the carrying amount at the end of year one, which is 480,400,000. So plus 300 million. This becomes 780.4 million. So this becomes the cost or the value of the asset as at the beginning of year two, which will be depreciated before the year end. So we were told that this asset no longer has 4 million or 5 million as the units that can be produced, but 8 million. So depreciation, remember that the requirement is to calculate carrying amount, and carrying amount is cost less accumulated depreciation less accumulated impairment losses. So depreciation for this year two, remember we will also have to use depreciable amount. So depreciable amount at the beginning of year two, depreciable amount, which we say is cost minus residual value. Our cost is now 780 million 400,000 minus, we were told that On 1st September 2016, the residual value of the machine was revised to 114 million. So at the end of the year of this asset, we can generate 114 million from the sale of this asset as a scrap, or after we have used it for all our production. In accordance with IAS 16, said assets are to be classified as an item of PPE when they are used in the ordinary course of business or for admin purposes. So depreciable amount at the beginning of year 2 becomes 780 million 400,000 minus scrap value, which is 104 million, which is giving us 666 million 400,000. So that's 666.4 million. So depreciation at the beginning of year 2, which will give rise to the current amount at the end, will be depreciation. We said depreciation is this depreciable amount spread over the useful life of the asset. So 666.4 million multiplied by, just like we did for year 1, said it can produce 1 million out of 500 out of 5 million units. Okay, so depreciable amount at, or depreciation at the end of year 2 will be, so in year 2, which is 31st August 2017, we're told that we can produce 1,200,000. But remember that I said that instead of 4 million units, we've produced 1 million for year 1, it should remain 4 million. So that 4 million, we were told that has increased to 8 million. The estimated useful life of the asset has increased to 8 million instead of 4 million because of the additional cost. So it means that each of them at each year have been doubled. So instead of 1,200,000, we'll have 2,400,000 as the units produced for year 2 out of 8 million units now. It will no longer be 1,200,000. So this will give us the depreciation amount for year 2. So 666.4 multiplied by 2,400,000 divided by 8 million. So we have 199,920,000. So that's depreciation for year 2. So depreciation, we have year 1. Year 1's depreciation is this. Year 2's depreciation is this. So 97.6 million. That's depreciation for year 1. Depreciation for year 2 is 199,920,000 in year 2. So carrying amount at the end of year 2, like I said, I'm shortening carrying amount for CA. So for year 2, we said carrying amount is cost less accumulated depreciation. So our costs as at the beginning of year 2 is 780.4 million. So 780.4 million minus 199.92 million. This will give us the carrying amount at the year of as the year of year 2. So 780.4 minus 199.92. So we have 580 million. 580 million. Sorry. 580 million. 480,000. So that's 580.48 million. That will be the carrying amount at the end of year 2, which is the requirement. So this is for the first one, year 1. This is for year 2. And let me just make it 1 and 2. This is 1. This is 2. So for year 3, we also need to calculate carrying amount for year 3, but we need depreciable amount. So the remainder, as at the end of year 2, we have 580 million 480,000. So year 2, year 3 rather, our depreciation for year 3, depreciation for year 3, we already have our depreciable amount, which is 780.4 million. Since this there's no other addition, this still remains the depreciable amount over the useful life of the asset. So depreciation for year 3 becomes 780 million point 4 times. So we were told that in year 3 we can produce 1,400,000 units. So which I said has been doubled, no longer 1,400,000 units, but to now be 2,800,000. That's 2.8 million out of 8 million units. So this gives us the depreciation for year 2, for year 3. So 780.4 times 2.8 divided by 8. So we have 273.14 million. So this becomes the depreciation for year 3. So carrying amount for year 3 now. So depreciation for year 3 we have 273.14. So okay, we're suspended in 1,000. 97,600, comma 140. So for year 3, the carrying amount now. Carrying amount, we said carrying amount is cost less accumulated depreciation less accumulated impairment. So the cost as at the end of year 2 is 580.48 million. So that will be depreciated, will be reduced by this amount. Or you do, we'll check that 580.4 million minus 273.14 million. So this will give us the carrying amount at the end of year 3. 580.4 minus 1.273.14, which is 307.26. So this will be the carrying amount at the end of year 3. So for year 4 now, year 4, depreciation which I said we're using depreciable amount. Depreciable amount is the amount that can be spread over the useful life of the assets, not the actual cost. So we have 780. Since there's no addition and no subtraction, it still remains the same. So we were told that in year 4 we can produce 800,000 units of product. So, and I said that these things have been, the units have been doubled because of the additional cost of 300 million has been added to this. So the production unit increased to 8 million instead of 5 million. So we have 1.6 million divided by 8 million. So we have 780.4 minus, multiplied by 1.6 divided by 8 million. So we have 156.08 million. So depreciation in year 4 is 156 and 80,080. So carrying amount in year 4 now, which we say is cost less accumulated depreciation less accumulated impairment losses. So the cost, which is the actual amount remaining as at the end of year 3, which is 307.26 minus 156.08 million, which is 307.26 minus 156.08. I have 0.18 million. So this becomes the carrying amount at the end of year 4. So here you can have the total expenses for each year. So we'll have so for this we have 10,000 plus 12 plus 18 plus 5 plus 4 plus 30 plus 97.6. So we have 176,600. 176,600,000. Here we'll have 199.92 plus 30. I have 229,920. And here we'll have 273.14 plus 30, which is 303, comma 303,140. Then we have 156.08 plus 30. We have 186,080. So the carrying amount at the end of each year. So at the end of year 1, the carrying amount is 480,400,000. The carrying amount at the end of year 2 is 580,480,000. Okay, seems there is an error here. 580,480,000. So this will change. 580 plus 48 minus 273.14. So 307.466 million. Wow, this was switching. 307.466 million minus 156.08. So 386. So 151.386. So this is the carrying amount at the end of year 1, which is this. The carrying amount at the end of year 2, the carrying amount at the end of year 3, and the carrying amount at the end of the 4th year, according to the question. So I hope this has been very clear. And in case there is any other question, please comment below so that we can address it. So briefly, we've been able to look at IAS 16 generally, talking about the recognition, the definition, the measurement, and the derecognition. We also talked about examples of items or assets which should not be classified under IAS 16, which is assets held for sale in the ordinary course of the business, assets held for capital appreciation, and also list assets, which is under list accounting for lease, which is IFRS 16. So those assets or items are not considered or classified under assets under IAS 16. So we also took an example to show the cost computation and also carrying amount, depreciation, depreciable amount, which I've explained that depreciable amount is the net amount which will be spread over the useful life of an asset after the deduction of the residual value. Before you can get depreciable amount, you must deduct residual value if you have in the question. So basically on the question, this becomes the solution. So the question is an ICAN November 2020 skills level question 6 question. So if there's any question relating to this particular solution, just comment below. Thank you. So if this video has been very helpful to you, please like, share to as many as possible, subscribe, and we'll see you again in the next video. My name still remains as Caleb, and this is Study with Clef. Thank you very much.